Are you planning on buying a home in 2021 and want to use a conventional loan? What are the conventional loan requirements for 2021? How do you start the process for getting approved for a conventional loan? In this video, we're going to dive into the conventional loan requirements for 2021, everything from credit score needed to down payment required, as well as what is needed with regards to your employment and assets. My name is Jeb Smith. I'm a real estate broker here in Southern California, and my goal with this channel is to help educate buyers, sellers, everyone with regards to the real estate process. So do me a favor, if you find value in that, hit that subscribe button and stay up to date on everything real estate related. So we're going to start today's video by talking about what a conventional loan is. What is a conventional loan? A conventional loan is a loan that's not backed by the government like FHA and VA. It's actually backed by investors, and the insurance is paid by the borrower. Now, conventional loans are a lot more common than FHA loans, but we're going to discuss some of the similarities to FHA. But if you want more information on FHA, do me a favor and click this video right here that goes over the FHA loan requirements for 2021. I want to start today's video by talking about credit requirements. What type of credit score is needed to do a conventional loan? Now, conventional loans have requirements set at a 620 credit score. While it might be hard to find investors out there that will actually do a 620 credit score depending on the down payment, type of property, and all of that stuff, the guidelines do allow a 620, but understand that a lot of lenders have overlays on their programs that won't allow them to go down to a 620. But know that the higher your credit score is, the better terms and the more preferable the loan is going to be in your favor. For example, if you're putting the minimal amount down with conventional, which is 3%, you're going to need at least a 720 credit score, preferably, but a 740 credit score would be better. Now, why do people do FHA loans at 3.5% down when they could do a conventional loan at 3% down? Well, that's one of the comparisons that I want to talk about here. Typically, if you're putting the minimal amount down with conventional, 3% versus FHA at 3.5%, the FHA loan actually ends up being a better loan with more favorable terms because they cater to the lower down payment borrowers as well as lower credit score borrowers in the case of their guidelines. So you actually get more favorable terms when doing an FHA loan versus a conventional loan when putting the minimal amount down. Now, there are some cons to doing FHA, which I'm not going to go into in this video, but I will link to a video here if you want to check that out. Now, while 3% is the minimal down payment for conventional, the more money you put down, the better the terms are going to be. The same is to be said for putting 5% down. Some cases putting 5% down versus doing an FHA at 3.5% down, because of the mortgage insurance that's required on the loan with conventional, it's better to do an FHA loan because it offers more favorable terms. But once you start putting at least 10% down, conventional loans typically offer better rates and terms than those of an FHA loan. Now, a moment ago, I mentioned PMI or MI, mortgage insurance. Mortgage insurance is required on any conventional loan where you put less than 20% down. Now, the pro for a conventional loan versus an FHA loan is that once you gain 20% equity in the property, that mortgage insurance can be removed, whereas FHA, if you're putting less than 10% down when buying that property, you're going to have the mortgage insurance on that loan for the life of the loan. So you might be asking, how do you get 20% equity in a property to get that mortgage insurance removed? It can happen one of a couple of ways. One, you can continue to make your payments on a monthly basis until you actually gain that 20% equity. So say you bought a property and put 10% down, and you continue to make your payments over a period of time and you get 20% equity in your property. You can reach out to the lender at that time and they can do an automatic valuation on your property to see what the appraised value is and look at how much you owe and determine whether or not you have 20% equity. Another way to do it is if you think your property has appreciated in a period of time where you now have that additional equity in the property in addition to what you put down. Lenders will allow either an automated valuation, or sometimes they will order an appraisal to make sure that the value's there. And if they see that you have the 20%, then that mortgage insurance can be removed. One cool thing about conventional versus, say, FHA is conventional can be used on primary residences, it can be used on second homes, it can be used on investment properties. But understand the 3% minimal down payment is for primary residences. As you buy second homes and investment properties, they require a larger down payment, whereas FHA loans only allow you to purchase for the purpose of primary residence, or at least living in one of the units in the case that you're buying multiple units. Conventional loans do have loan limit requirements depending on where you're located in the country. Their base loan amount is $548,250, so that's going to cover the majority of areas out there. That's going to be the max amount that conventional will allow you to finance under their program. But if you live in a high cost area like Southern California, it will be 150% of that $548,250 that we just mentioned and take you to an amount of $822,375. But keep in mind, as you buy units with conventional, 2 units, 3 units, 4 units, that means if you buy a duplex, a triplex, or a fourplex, those loan amounts go up. So even in the standard cost areas, you're going to have higher loan amounts on units. And the same is said for the high balance areas, like here in Southern California. The 1 unit is $822,375, but if you're purchasing a duplex, a triplex, or a fourplex, you can see here that the loan limits go up with each unit, and that is the maximum amount that you can finance on that particular property in those areas. Now, what I'll do is I'll actually put a link below where you can check the max loan limit in your area using conventional loans, just in case you're curious. Now let's talk about employment and asset verification. With any type of loan program, you're going to need steady employment. What do I mean by that? You're going to traditionally need at least 2 years of employment in the same line of work. So it doesn't matter if you're buying FHA, you're using conventional, you're doing a VA loan, the lender's going to want to see some consistency in your employment and your income. Now, your income can increase over time, and they'll likely take an average of it as long as the increases are not crazily in jumps and what have you. And the same is to be said if your income is going down. If you see large jumps going down in your income, they're likely not going to average. They're going to use the most recent year in those cases, but they do want to see some consistency in your income. They're also going to want to see some assets. So assets can be 401k, it can be stock accounts, it can be checking, it can be savings. They want to see that you have some money in the bank. They want to see where the down payment's coming from. They want to verify that information. And with conventional, one of the things versus FHA is that FHA traditionally doesn't want to see reserves. So what are reserves? Reserves are money that's left over after you put your down payment down, after you pay your closing costs. It's the money left over in your account. Traditionally, FHA doesn't want to see that, whereas conventional, it can come up. Sometimes they want to see that you have at least 2 months reserves. Reserves would be your principal, interest, taxes, and insurance on that property. So if your payment is $3,000 a month with all of that included, they may want to see that you have that $6,000 in reserves in order for you to be approved for that loan. Another thing with conventional financing is that they don't necessarily require impounds, which are your taxes and insurance, to be included in your monthly payment, whereas FHA and VA, some of these other programs do require that. So, what I would recommend is if you're looking to buy a property and you want to use conventional finance, or you're considering using conventional financing, make sure you're speaking to a mortgage professional. Make sure you understand, you're working with someone who understands the business, that has a reputation, that's been doing it for some extended period of time. And if you don't have that person, do me a favor, reach out to me directly. I'm happy to put you in touch with someone. Regardless of where you're located in the United States, I'll definitely put you in touch with someone who does business the same way I do, that can take good care of you and guide you in the right direction. Now, keep in mind, as a real estate professional, I don't do loans, right? This video is just for education. But understand, I don't get anything from making that referral. I'm doing this just to help you out, to, make sure you're in good hands and getting taken care of. Because I appreciate you watching my videos. I appreciate all the support that you guys give me. And, as I normally ask, if you're still watching this video and you haven't done so already, do me a favor and hit that like button. Leave me a comment if you have questions. If you want more information about conventional loans, you can reach out to me directly. You can comment below. I'm happy to do that information. But for now, I appreciate you taking the time to watch. I appreciate your support. Hope to see you again soon. Have a great day. Bye-bye.